Question 16. The materiality test means that A. Transactions are considered material if their amount exceeds $10. B. Items can be excluded from the firm's financial reports if their omission will not significantly affect decision making. C. Items can be excluded from the firm's financial reports if all items of the same or a lesser amount are also excluded. Or D. All of the above. Let's start with option C. Can we take out something of a small value? Say we're doing the stationary asset, we can leave out a dollar stapler. If we leave out everything of the same or a lesser amount, that doesn't really make sense because, depending on the business, what's significant in terms of a dollar and what's not is very different. So we're going to get rid of option C. Now we've gotten rid of option C, that must mean that there is no all of the above option, so we're going to get rid of option D. That leaves us with A and B. Let's look at A. The materiality test means you should include or consider things material if they are larger than $10. Is that true? It depends on the business. For example, let's look at the Reject Shop. In 2014, the Reject Shop's revenue was $711.5 million. And in 2015, that went up to $756.8 million. So that is a really big business. Is it so big that we should, if something's under $10, can we not include it in the financial reports because it's not material? Well, that's clearly not true, because if you look at the Reject Shop, all its merchandise, that's what it sells for. It sells for $1.50, $4, $1, $3, $2, whatever it is. But in their books, it's actually going to be valued at less than that because it would be valued at the cost price. If you exclude one glass there that's worth $1, one jar, you can't exclude all of them because each one on its own, whilst it mightn't be a huge number, when you add them all up together, they are considered big enough to be material. So there is no rule about what's material being over a certain dollar amount. It's not $1, it's not $10, it's not $100 or $1 million. It's completely different for different businesses. So we can't really put a dollar figure on materiality. Based on that, we're going to get rid of option A. And it's all to do with the qualitative characteristic of relevance. It says information is relevant if it influences the decision making of the user. And part of that is what's called this materiality test. Materiality says we should only include items that are material in the financial reports, and an item is material enough if it's large enough to influence decision making, and if I left it out or omitted it or misstated it or got it wrong, I'd get a bad decision. There's nothing here about materiality saying if it's above $10 it goes in, if it's under $10 it goes out. The Reject Shop example showed that a company that's got hundreds of millions of dollars in revenue would still consider something that's worth $1 as very material. So we're going to get rid of option A. That leaves option B. The materiality test means items can be excluded if we think their omission will not significantly affect their decision making.